welcome to the second of our Investment Insights series, Magellan Minutes. This series is designed to provide you with relevant and digestible talking points on global markets, each in around 10 minutes. In this series, we're going to revisit some of the conversations we had earlier this year and share our current views on the sectors and stocks in our global portfolios. We will also ask our sector specialists what they'll be looking out for in 2021. My name is Jennifer Herbert, Key Account Manager at Magellan, and today I'll be talking with Magellan's Co-Head of Technology, Communications and Media, Ryan Joyce, about our views on the internet and e-commerce platforms. Thanks for joining us, Ryan.
No problem, Jen.
Ryan, last time we caught up, we discussed our expectations of Alphabet and Facebook through COVID. Have these companies behaved the way we expected them to?
Certainly, I would say both companies have actually performed better than what we'd expected. And there's a couple reasons for that. And I'll start with the reasons that are common to both companies and then talk a little bit about the performance of each company. So starting with why they performed better, the first thing I'd point to is the government response we've seen through this crisis. Early on, there were legitimate concerns regarding the economic impact that COVID would have. It's obviously been very significant, but it could have been much worse. And we saw governments respond quite early to help protect household budgets and balance sheets and ensure that the consumer could continue to spend on goods and services that were still open during this period. And so what that meant is that businesses still wanted to advertise, they still wanted to reach those consumers. So we saw consumer spending hold up quite well. And encouragingly, we now have positive vaccine results, which provide that path to reopening. So that's point one. The second point is the unique dynamics of COVID obviously benefited Facebook and Alphabet to some extent. We obviously had the closure of brick and mortar retail and lockdown that meant people couldn't go outside as much. So people were spending more time online and spending more of their money online via e-commerce. And reflecting that, we saw merchants shift their budgets and their kind of attention online as well. And to reach people online, obviously, these are two of the most important businesses in the world, and they saw some benefit from that. They've also lent into this trend. So we saw Facebook, for example, release Facebook and Instagram shops a little bit earlier than it would have, which helps convert traffic on its platform all the way from advertising through to purchase. And we also saw Alphabet take some steps to increase the attractiveness of its Google Shopping platform. In terms of the individual companies, if we look at Alphabet, they were growing revenue around 20% going into COVID, and that hit a bit of a wall in Q2, got slowing to 0%. But we saw a strong bounce back in Q3 to 15%, and we're seeing continued acceleration coming through. One part of their business that is yet to recover is the travel vertical, which is a large business for them. Around 10% of their advertising revenue is our estimate. But with those vaccines coming, we expect that to recover as well. Now, on the non-advertising part of its business, those parts have also performed well. So Play Store is benefiting from that shift in activity online. And we've also seen Google Cloud Platform maintain its growth above 40% through this period. And Google's actually announced that they're going to break out the profitability of that business going forward, which we also think is quite positive. In terms of Facebook, they were growing a little bit faster coming into COVID. So they were growing around 24%. They also decelerated to 10%, but bounced back to 22% in Q3. And they've actually guided to faster growth in Q4. Now, it's quite interesting. If you think coming into this, we were expecting their growth to decelerate. Exiting the year, they're going to be growing faster than what we'd anticipated, even before the impact of COVID. So those positive dynamics that I've spoken about that played to the strengths of Facebook and Alphabet have actually offset that kind of economic impact.
There's been added pressure around regulation, especially for Facebook, with a lot of focus on its social implications. Would you say that this is Facebook's greatest current challenge?
Absolutely. I think regulatory risk and navigating the regulatory landscape is probably the greatest challenge, not just currently, but for the next decade for Facebook. These issues aren't going to go away. They operate in a lot of countries, and there's a lot of different opinions and views on how they should be addressed. In terms of the specific regulatory risks that Facebook is facing, I bucket them in kind of four main areas. So those include antitrust, data privacy, platform security, and content moderation. So I might just discuss each of those in turn. If we start with antitrust, the FTC filed a lawsuit against Facebook earlier this week alleging anti-competitive practices and asking the courts to require Facebook to actually divest Instagram and WhatsApp. I'll just make 3 points kind of on that lawsuit. The first is that, interestingly, the share price didn't move on that news. And so what does that tell us? It tells us that people were already expecting this. There'd been rumors that this lawsuit was coming for many months. And so it's not surprising. The second is that we think it's quite likely that Facebook will prevail in court. So they've already said they're going to challenge it. These acquisitions were previously approved by the FTC. We think it's also going to be difficult for the FTC in its lawsuit to establish direct consumer harm, which is what's required in the US to force this separation. Also, just from a perspective of competition, we think there is meaningful competition for user attention and time spent online. The final point, and it's an important one, is the downside we think is relatively limited, even if they were to lose the case and we did see a forced separation. Facebook and Instagram by themselves are very valuable businesses. And even if there were to be some cost duplication as a result of the separation, we think it'd be quite manageable for the two businesses. There's also, we think, very little in Facebook's current share price for WhatsApp. This is a messaging service with over 2 billion users globally. It's probably loss-making at the moment, but we think valued independently on public markets, it would be worth a lot of money. So we don't see that as a value destructive event, even if it were to occur. The next issue is data privacy. This is obviously something that's getting increased attention and rightly so. We've seen regulation come through in places like Europe and California in particular, but also in many other jurisdictions that restrict the ability to, not just of Facebook, but all companies to kind of gather and share data. And we're seeing Apple also play a role in trying to limit that data sharing and gathering by third parties. And Facebook itself is taking some proactive steps in terms of providing options to users to limit the use of data for ad targeting or delete their data or the so-called right to be forgotten. And we expect those trends to continue. They do provide a modest headwind to ad prices, but we think they're quite manageable, particularly for Facebook, which has a lot of its own data. So it's not as reliant on third-party data as many other platforms or publishers. The next one is platform security. And this, to some extent, was a big issue a few years ago. There were instances of proven foreign government interference in domestic issues. This was a very sensitive issue and something that Facebook needed to solve. They've invested heavily in that area over the past few years, and it seems to be an area that they've largely addressed. So it's an area that they need to stay on top of, but something that we don't think is going to create too many challenges going forward. The final point is one around content moderation. So that's including things like fake news, bullying, graphic content that people just don't want to see on those platforms. And this is a very difficult issue because it's a gray area, and different parts of politics and different people want different things. In the US, the Republicans want less stuff taken down. The Democrats want more stuff taken down. And Facebook's kind of stuck in the middle and unable to please either side. And so you have different solutions being put forward, but nothing really happening. And Facebook's asking for some clear rules to be set out by the government that it can follow rather than trying to make the rules itself. But whether that happens is hard to say. We think it's probably more likely that you could maintain this status quo of trying to manage both sides without too much progress. But certainly a lot of regulatory issues that Facebook needs to navigate.
Turning now to our Chinese tech holdings, Alibaba and Tencent, we've discussed the growth opportunities we see here at length. There now seems to be much in the media about tech regulation within China, and we've recently seen the Ant Financial IPO pulled as a direct result. Do we see this as problematic to our thesis for both these Chinese holdings?
We don't, and I'll elaborate a little bit on why that is. The first point, I think it's important not to conflate the Ant IPO being pulled with the release of a draft paper on antitrust regulation for platform companies. In China, the Ant IPO, we think, was a very specific issue, one around financial market stability and the disintermediation of traditional financial institutions. And Ant's scale and rapid growth was creating some issues that the regulators really wanted to get comfortable with. And it was obviously the timing of that was quite rushed. It happened very last minute. So all seemed quite dramatic and alarming. Whereas if you contrast that with the draft guidelines that were released, this is a continuation of anti-monopoly law development in China that's been ongoing for the past decade. And it's really about how to apply those laws to platform companies. If you go through the draft guidelines, they're all quite sensible in what they're discussing. It's nothing too drastic in there. The timing's quite measured. It's by its nature, it's a draft. So they are looking to consult with industry about this. So quite a different kind of context around the release of those two things. It's also the same issues that are being dealt with around the world. This isn't something that's unique to China. These are the same issues being dealt with that we kind of spoke about regarding Facebook and other companies in many other countries. So in terms of the potential impact, it's early days in terms of how those guidelines will be developed and how they may change, but we're quite relaxed about the potential impact they could have. We think they may reduce the flexibility of Tencent and Alibaba and how they compete, for example, in certain ways, and they may reduce some of the advantages or limit some of the behaviors that they have been able to do to maintain their position. But at the same time, this is a battle that in many respects has already been won. They've established their dominance in their respective verticals. And so changing that by itself is going to be very difficult. And if we think about e-commerce in China, for example, there's 3 quite large platforms and competition between them is already quite fierce. So from that perspective, we don't think it changes a whole lot, but it's certainly an issue that we'll continue to keep an eye on.
Netflix is a recent addition to the portfolio. Could you share the underlying investment case with us and why we have conviction in this name?
Certainly. The underlying thesis is that Netflix is competitively advantaged in streamed video, that streamed video itself has a very long runway for growth, and that Netflix has significant pricing power that it will be able to exercise over time. So let me expand on those factors. Starting with the competitive advantage, streamed video is a scale game, both globally and locally due to the scalability of content. And no one has more scale than Netflix. It has nearly 200 million subscribers and it's adding around 30 million new subscribers each year. So continuing to build that scale advantage. Now, in addition to that global scale, Netflix is also the leader in a lot of individual countries, and not just in terms of its subscriber count, but in terms of its knowledge of those markets. It's been operating in many markets for 5 to 10 years, and it understands consumers' taste for content. It's been developing local content to meet those tastes. It's been building distribution partnerships with local wireless and other internet companies, for example, to really get its product out there. And outside of Amazon, that's very unique. So a lot of the traditional big media companies are still very focused on the US. They haven't even rolled out kind of these general entertainment streaming services on a global basis yet. So that provides a very strong head start for Netflix, even though penetration in some of those markets today is quite low. In terms of that penetration being quite low today in many markets, that leads me to the second point in terms of that long runway for growth. Despite having 200 million subscribers, we think Netflix can add another 200 million over the next decade, reaching close to 400 million subscribers by 2030, which is obviously very attractive. The last point we'd make is around pricing power. So Netflix currently charges around $10 a month for its service. That's about the price of a movie ticket. In return for that, you obviously get a huge catalog of content that's constantly refreshed in terms of new movies, new TV shows, with content for the whole family. And we think that has been very important to driving adoption of the service, that's very strong value proposition, but it also provides Netflix an opportunity to steadily increase prices over time. And we think that combination of steadily increasing prices and the ability to continue to grow subscribers for a long period will be very attractive for Netflix shareholders.
Ryan, thank you so much for sharing your insights with us today.
It's been a pleasure, Jen.
And thank you for watching. If you have any questions, please do not hesitate to contact one of the Magellan team, and feel free to share this update with clients or colleagues as you see fit. Take care and stay well.